After the crash, cheap money, expensive buildings. When the financial system stalled in 2008, cranes stopped midair. Cities faced empty lots, busted budgets, and headlines about blight. They needed construction, jobs, and tax base fast. Developers needed certainty. What they got was the cheapest money in modern memory. Central banks pushed rates to the floor. In real estate meetings, a phrase took over the whiteboards: bond-like apartments. Put simply, with interest rates near zero, big investors hunted for steady yield. Apartment buildings, especially new, well-located ones, looked like predictable income machines. If you were a pension fund manager or a REIT, collecting thousands of rent checks every month sounded safer than betting on malls or offices. Meanwhile, lenders preferred clean, core projects with strong tenants and glossy amenities. Risk was out, predictability was in. Here's the catch: predictability costs money. Construction prices were climbing: steel, concrete, labor, insurance. Land sellers remembered the last peak and wanted yesterday's prices tomorrow. For a project to pencil, the pro forma had to assume high rents on day one. That meant designing for people who could pay the most. Class A, top-of-market units with a pool, a clubhouse, a co-working lounge, pet spa, and a lobby that photographs well. A mid-tier, no-frills building couldn't carry the land cost plus the rising soft costs: architecture, legal, permitting, impact fees. Unless the developer accepted lower returns and higher risk. Most didn't. The spreadsheets spoke louder than policy speeches. If you can finance a tower that throws off reliable income and hits a target IRR, why take a flyer on a modest walk-up that banks view as riskier and that can't command premium rents? Meanwhile, secondary and older stock, the Class B and C apartments where working households actually lived, became targets for value add. Instead of building new affordable units, investors bought older ones, renovated kitchens and bathrooms, added a gym, then raised rents. On paper, value add upgraded the housing stock. On the ground, the cheapest apartments left became tomorrow's mid-tier, and yesterday's mid-tier got priced as luxury light. The safety valve, naturally occurring affordable housing, started closing. Cities tried to entice building with fast-tracked permits and ribbon cuttings, but the capital already had preferences. Debt was cheap. Equity demanded certainty. A 300-unit Class A deal felt like a bond. More units to spread risk, professional management, and a marketing playbook copied across markets. Smaller, missing-middle projects, duplexes, fourplexes, courtyard apartments, struggled. The loans were harder, the timeline slower, the fees smaller. The money followed scale. Get this, the psychology mattered as much as the math. In the aftermath of the crash, prime became a talisman. Leasing teams learned to sell status: quartz counters, roof decks with skyline selfies, dog washes with branded towels. Amenities became not just features, but underwriting assumptions. If the project needed rents at $3 per square foot to pencil, the design had to justify it. So developers stacked amenities, not because tenants begged for golf simulators, but because lenders wanted proof that top rents were attainable. The sale wasn't shelter, it was identity, by the lifestyle, prove you belong, and fear missing out if you don't. On the street, the human math was brutal. A teacher hit with a 15% rent hike after a light renovation. A line cook told their building was repositioning and would need everyone out for life safety upgrades. Families faced a choice that kept repeating: upgrade or leave, pay more for a smaller place, or start a longer commute. The city's population stats might show growth, but neighborhood by neighborhood, the people holding the service economy together were pushed to the edges. Stress became a monthly payment, renewal notice as adrenaline spike, uncertainty as a line item. Policymakers insisted that more units would eventually filter down, that today's luxury is tomorrow's affordability. But filtering takes time, and time works differently when capital is targeting quarterly returns. With land traded at high prices, each wave of construction needed equal or higher rents to justify itself. And because the vast majority of new units were Class A, the future filter was a pipeline of premium product, not a broad base of modest, durable housing. Meanwhile, low interest rates did something subtle to competition. When everyone can borrow cheaply, more bidders show up for the same parcels. Land auctions got frothy. Sellers set expectations using the top-of-market numbers, and those numbers only penciled with premium rents. The result was circular. Cheap money made land more expensive. Expensive land demanded higher rents. Higher rents required more amenities. More amenities pushed projects further from affordability. 3 years into the boom, you could stand at the edge of a downtown and count the pattern. Cranes over glassy mid-rises, identical floor plans, similar finishes, and rent rolls that looked like spreadsheets passed around a conference. The diversity of form that keeps a city resilient. Triplexes tucked behind main streets, courtyard buildings with long-term owners, wasn't growing. In some neighborhoods, it was disappearing, replaced by a consistent, finance-friendly product. What nobody knew at the time, or pretended not to notice, was how much the tax code was amplifying these choices. Depreciation schedules, interest deductibility, and exchanges shaped where returns peaked. Local abatements promised to make deals pencil, but the deals already aimed high. Cities got the headlines, investors got the yield, renters got the bill. This was the moment everything changed. Cheap debt didn't just restart construction, it picked a lane. And once capital picked luxury, the rest of the system, from design to marketing to permitting, snapped to attention. The trap was set long before the first lobby chandelier arrived. But low rates weren't the only accelerant. The real lock-in came from policy. To see why luxury became the default, we need to open the tax code that quietly steered billions toward the most expensive units. The tax code that built luxury, and not much else. What gets rewarded gets built. After the crash, the rewards lived in the tax code. On a developer's scratch pad, the first line isn't rent, it's basis. Because basis determines depreciation, and depreciation is where real estate turns taxes into fuel. Accelerated depreciation and cost segregation let owners write off components, roofs, fixtures, appliances on faster schedules. That creates paper losses that can shelter real income. The bigger and more expensive the building, the larger the depreciation shield. Luxury doesn't just look nice, it throws a bigger tax shadow. Now layer in interest deductibility. When debt service is deductible, leverage lowers taxable income even more. Stack cheap floating rate loans from Chapter 1 with interest write-offs, and every additional dollar of spending on premium finishes can be framed as both revenue-enhancing and tax-efficient. Costly amenities become investments that upgrade the cost seg study. The spreadsheet smiles on marble. Then there's the exit. The 1031 exchange turns a sale into a leapfrog. Sell a tower, defer the capital gains and depreciation recapture by rolling into a bigger, pricier project. The incentive is to trade up in value, size, and complexity. A small, modest rehab doesn't scale the same deferral. A $200 million luxury asset does. If you're competing for land and you've got a buyer behind you who can swap into your future building to defer 8 figures in tax, your bid wins. Affordable lost before the first site plan meeting. Local governments piled on with abatements and pilots. On paper, these swap future property taxes for near-term development. In practice, the deals often tied the abatement to height, density, and a performance standard. Exactly the criteria luxury projects are built to ace. Cities asked for token affordable tiers, 10, maybe 20% of units, priced to 80 or 100% of area median income. For many working-class renters, those affordable rents still overshot take-home pay. The wait list stretched years. The lottery odds felt like a joke. Inclusionary zoning dangled bonuses. More height, more units, in exchange for those set-asides. But the math is brutal. Extra floors only work if the market rate units can command premium numbers. That pushes design choices toward high-end finishes and amenities, so comps justify the ask. The bonus morphs into a requirement to go upscale. Mid-market builders, facing thin margins and no density bump at their scale, get outbid on land or never apply. Meanwhile, pilot structures and negotiated abatements reward predictability. Luxury projects show lenders clean pro formas, recognizable operators, and third-party management with track records. That lowers underwriting haircuts, which raises proceeds. Higher proceeds let sponsors pay more for land. A missing middle project with smaller unit counts would framing an A. First-time sponsor can't match. The financing gap becomes a bulldozer. Even the affordable carve-outs tilt upward. Many cities peg rents to AMI bands that blend wealthy suburbs with city neighborhoods. If the metro's median is inflated, the restricted, affordable units price well above what local service workers can spend. Renters earning slightly too much for subsidy and too little for market get squeezed from both sides. They don't qualify for the set-aside, and they can't clear the luxury screen. They double up, move farther, or leave. On the investment side, partnerships exploit the tax stack. Limited partners get allocated depreciation losses early, then harvest deferral on exit through 1031 or Opportunity Zone rollovers in the next chapter. Sponsors collect fees at each stage: acquisition, development, asset management, so they're paid regardless of future rent burdens. With tax shields smoothing returns, target IRRs favor bigger bases and faster cost seg. A granite lobby isn't just branding, it's an accounting strategy. Property tax abatements also run on clocks. A 10 or 15-year abatement period lines up with hold timelines. As abatements burn off, rents are already anchored high, and comps defend the level. The building doesn't step down to affordability when the break ends. It steps up to cover the new tax bill. Cities get revenue, but tenants inherit the cliff. There's a quieter lever: basis step up. When assets change hands, new owners reset depreciation schedules to the purchase price. High valuations create fresh tax shelters. That encourages trades at top dollar, which in turn raises assessed values, which raises property taxes on nearby older buildings. Smaller landlords face higher bills and sell or upgrade to keep pace. The spiral nudges NOAA toward value add, long before any real improvement is needed. Developers will tell you they're just following the rules. They are. The rules point them upmarket. If accelerated depreciation rewards larger capital stacks, interest deductibility blesses leverage, 1031 defers taxes if you scale, and local abatements unlock only when you build big, then the rational move is luxury. Affordable deals lose land bids, lose loan proceeds, and lose patience in permitting lines designed for megaprojects. 10 miles from downtown, a nurse and a bus driver toured a workforce unit labeled affordable. The rent was pegged at 80% AMI. It still beat their monthly budget by $400. They joined a waitlist with 2,300 names. Across the street, a new tower with 2 months free was leasing one-bedrooms to remote workers. On paper, supply went up. In practice, access went down. What nobody knew at the time, because it hid behind neutral language, was that the code's biggest gifts scale with cost. The more you spend, the more you can write off, defer, and leverage. Cities tried to pull affordability in with set-asides, but the math kept pushing luxury out the door first. Even when subsidies existed, they triggered a gold rush of almost affordable, anchored by premium rents upstairs. And that was before a new program promised tax-free gains in distressed zones. The LIHTC/LURA puzzle. When affordable isn't affordable. To understand the promise and the trap, watch a groundbreaking ceremony on a hot afternoon. A banner reads, "Affordable homes coming soon." The financing stack behind the ribbon looks impressive. Low-income housing tax credits, a construction loan, a syndicator, and a compliance monitor. The mayor thanks partners. The crowd claps. A family at the back whispers, "Do we qualify?" That question is the pivot of this entire chapter. LIHTC was built to bring private capital into low-income housing. It works by giving investors tax credits in exchange for reserving units at restricted rents for a set period, typically 15 years, monitored by a land use restriction agreement with extended compliance to 30. On paper, that's a lifeline. In practice, the income bands and the timelines can miss the people standing in line today. Start with the bands. Rents are pegged to area median income, not neighborhood paychecks. In high-cost metros, AMI pulls in affluent suburbs, lifting the median. So an affordable one-bedroom at 60% AMI can still land a couple $100s above what a grocery clerk and a delivery driver can manage. The next tier, 80% AMI, often sits closer to new workforce product than to what a nursing aide can afford. Families earning just over the cutoff don't qualify. Families just under it qualify, but still sweat the monthly nut. Meanwhile, compliance periods create a clock. The first 15 years are the credit delivery window. The extended use period stretches affordability on paper. But time moves differently for buildings. Roofs age, systems wear, reserves run thin. As the initial credits are exhausted, the temptation appears. Recapitalize with a rehab, resyndicate, or convert to market at the first legal opening. If the land beneath has appreciated, the exit can be irresistible. What was built as affordable becomes a chip in a hotter game. Inside the capital stack, there's a second clock: fees. Developers charge for acquisition, development, and guarantees. Syndicators take a cut for packaging credits to investors. property managers collect. None of this is illegal or even unusual, it's how the program moves. But it means the first dollars raised serve the structure before they serve the tenants. The incentive is to close deals that fit the box, even if the box doesn't fit the local need. Consider the rent laddering. A building might set aside units at 30, 50, and 60% AMI. The 30% units are scarce and oversubscribed. The 60% fill faster but bite harder. Residents in the missing middle, too high for subsidy, too low for market, find themselves shut out. They don't show up in the ribbon-cutting photos, but they show up in the moving vans heading farther from work. Then there's the LURA, the Land Use Restriction Agreement, that runs with the land. It keeps units affordable during the term, with audits, income recertifications, and reporting. Ask any property manager. The paperwork is real. Now ask a tenant earning hourly wages with tips and gig shifts to produce clean income documentation every year. Miss a form, get a raise, add a roommate to cover childcare, eligibility can wobble. People hold back extra hours to stay under thresholds. The program that should relieve stress sometimes adds it. As compliance ages, the conversion risk rises. In year 16, loans mature, capital calls loom, and neighboring market rents look tempting. Some owners preserve affordability by re-upping with new credits and rehab dollars. Others sell. The building re-enters the market, rents reset, and the people who built lives their face notices. The neighborhood loses predictable rent anchors, and schools, church groups, and bus routes feel the churn. Syndication adds another layer. Investors buy credits to lower their tax bills, expecting stable delivery. Their priority is compliance and yield, not deeper affordability. Deals that underwrite to lower AMI bands are harder to finance. They generate less rent to cover operations and debt. Sponsors juggle, go deeper in risk gaps, or float higher to please underwriting. Over time, the portfolio drifts upward. A mother named Alondra illustrates the squeeze. She earns slightly above the threshold for a 60% unit, thanks to overtime at the hospital. She doesn't qualify. Market rate nearby wants $900 more than she can spare. The affordable building across town has a 3-year wait list. She keeps her kids in their current school by renting a smaller place and sleeping on a pull-out couch. Here's the quiet twist. Even when LIHTC delivers, it rarely delivers at the scale or permanence needed. The program depends on annual allocations, competitive awards, and layers of gap financing. It's slow. It's precise. It's not built to flood the zone. And because restricted rents don't rise to cover late-cycle cost spikes, more deals rely on soft funds that cities can't guarantee year after year. What nobody knew at the time, until expirations hit, was how fragile affordable can be when it's a compliance term, not a covenant with money behind it forever. The credits did their job. The buildings opened, but the families in the middle kept falling through. Meanwhile, a new tax shelter promised something shinier: appreciation with a tax-free exit in distressed maps. Opportunity zones, tax-free gains, premium rents. 3 blocks from a boarded-up laundromat, a ribbon stretches across a polished lobby. The sign says Opportunity Zone Investment. Inside, the leasing desk quotes 1 bedroom starting at a number that outruns the neighborhood's median paycheck by miles. The crowd at the opening heard the pitch: jobs, revitalization, and quietly, the punchline that brought the money here in the first place: tax-free appreciation. To understand why, go back to 2017. Opportunity zones took census tracts labeled distressed and promised investors a trilogy of benefits. First, defer capital gains by rolling them into a qualified opportunity fund. Second, reduce the taxable amount if you held long enough. Third, and most seductive, exclude the future appreciation if you held the new investment for at least 10 years. That last clause rewired the map of what counted as a good deal. Here's the wrinkle. Governors drew the zone maps off eligible tracts, and those maps sometimes wrapped hot corridors, waterfronts, downtown edges, neighborhoods already inches from a tipping point. Developers call it designation arbitrage. Find a tract that qualifies on paper but sits next to a rising district. Build where the upside already wants to go. The brochure shows community uplift. The spreadsheet sees tax-free gains where appreciation is most likely. Walk the capital stack. A sponsor forms a fund, gathers investors sitting on stock gains, business sale proceeds, or property dispositions. Those investors face taxes now or deferral and possible exclusion later. The fund scouts OZ tracts, Then target sites that can support premium rents, because those rents help finance the land and construction while the real prize, appreciation, ripens in the background. If the exit in year 10 can be tax-free, the model leans toward places with the strongest rent growth, not the deepest affordability need. Now add local incentives. Cities, hungry for OZ headlines, sometimes layered abatements or fee waivers on top. The sales pitch: we're catalyzing investment in overlooked areas. The effect: an extra boost for projects that already chose high-end finishes to command rents that banks bless. If a building needs $3,000 rents to cover debt, it's not aiming at the families who've been holding the neighborhood together. The benefits were supposed to come with accountability, but reporting landed soft. Funds disclosed broadly. Communities struggled to verify promises. Job counts included temporary construction work. Community benefits showed up as a meeting or a small grant. Meanwhile, the new building's rent roll launched well above local medians. When a coffee shop and a boutique gym followed, the optics matched the worries. The zone revived, just not for the people living there before the ribbon cutting. A micro-story from a riverfront tract tells it. A small landlord, pressed by rising offers and a looming roof repair, sold a fourplex to an OZ-backed buyer at a price he couldn't refuse. The buyer planned a teardown and a mid-rise. The seller paid off debts, moved to the suburbs, and retired. The tenants got non-renewals. 16 months later, a pool deck opened with skyline views and founder rates that still beat nothing in the neighborhood's wage math. Meanwhile, some sponsors used the OZ framework to refinance after stabilization, pull out equity tax efficiently, and hold for the 10-year mark. The building's operations, amenity fees, parking, pet rent, were tuned to lift NOI, which set higher valuations later. The strategy wasn't illegal, it followed the rules. But it anchored a price level that neighboring landlords used as comps. The zone effect rippled across a map where most residents weren't investors. What nobody knew at the time, because the clock hadn't run yet, was how 10-year horizons would shape behavior. When the payoff is the sale, preservation isn't the priority, momentum is. That meant leasing teams held firm on premium tiers to defend valuations. Even in soft patches, concessions stayed short-term, 1 month free, while asking rents marked the future comp vacancies could sit longer than a neighborhood could afford. There were exceptions. A handful of mission-driven funds paired OZ equity with deeper affordability covenants, building mixed-income projects with real rent bands. They worked, but the math needed extra subsidy and patient investors. Most capital wasn't patient. It was tax-savvy. From their perspective, OZs were a once-in-a-generation carve-out. From the ground, they felt like a speed-up of trends already in motion. More polished buildings where appreciation looked safest. The policy intent, revive distressed areas, met the finance reality, protect principal, chase upside, minimize taxes. At a community meeting, a resident asked the developer if any units would be priced to what home health aides earn. The answer: we're offering workforce housing. The number that followed was a full paycheck away. She folded the flyer and left early. Opportunity zones didn't invent luxury. They rewarded it in places labeled left behind. The maps looked like a promise. The leases read like a warning. And across town, city halls were stacking their own sweeteners on the same playbook.